Welcome to Biz Wire. I'm Joseph Nordstrom in Beijing. After some initial disappointment, China watchers are coming to agree that the recent Communist Party's Central Committee meeting offered much that reformers can be happy about on the economic front, including a few surprises. China's officials indicated on Tuesday how they plan to steer reforms on interest rates, the currency, and stock markets. And one of those unexpected changes is to the country's system for listing new shares on the stock markets in Shanghai and Shenzhen. Reuters reports that China may reduce the influence of the state on stock markets, including making it easier for companies to list their stocks and making management of state-owned enterprises more accountable to shareholders. The Wall Street Journal said that China's current initial offering system is more of a planned economy-style mechanism that has long been criticized as one of the fundamental deficiencies plaguing its stock market. Chairman of China's top equity regulator, Xiaogang, says implementing the registration-based share offering system will be a significant move towards a more market-oriented economy and in modernizing the country's financial system. On Tuesday, Xiaogang said the move will return power to the market as well as to investors in a keynote speech at the Caijing Annual Conference 2014, at which former U.S. President Bill Clinton also spoke. Xiaogang also said the government will also intensify its auditing of companies that hope to list. The China Securities and Regulatory Commission hasn't allowed an IPO since October of last year. While the stated reason for the suspension of approvals for new initial public offerings was to clean up fraud by forcing underwriters to review the accuracy of pending IPO applications. Reuters reports that the ban was widely understood to be an effort to prop up the chronically weak stock market by restricting the supply of new shares. Some say lifting the suspension would be a signal that officials are willing to let markets take more control. The reform will bring China's IPO vetting process closer to that in developed countries, where firms register their IPOs and go through a rigorous audit before listing. Xiaogang also said China will allow more qualified foreign investors to enter China's stock market, but conditions are not yet ripe for China to launch a long-awaited international board. Following up on that, central bank chief Zhou Xiaochuan vowed to quicken the process of full yuan convertibility, which would allow the free movement of capital across China's borders, and which has been a long-time demand of many of the country's major trading partners. Reuters also reports that the government wants to encourage increased equity financing, which would help wean Chinese firms off of their overdependence on bank loans for funding. Since the financial crisis, corporate and local government debt in China has exploded. Fitch estimates that the economy-wide debt-to-GDP ratio will reach around 218% of GDP by the end of this year, up 87 percentage points since 2008. Analyst at Sinolink Securities, Huang Zhendong, cautioned that the reforms are expected to be gradual in nature and could take as many as 7 years to be fully implemented. You're watching Biz Wire on the Blue Ocean Network, China's first and only privately owned broadcast media. Our full episode can be seen on our website, BONTV/biz-wire. In just a second, we'll continue with more insight into the big picture of China's economy.